All right, ladies and gentlemen, folks, let's rock and roll. We got some more stuff to cover. You ready? You ready? That
Yes.
does not sound like you're ready at all.
Yes.
It kind of sounds like you're still at break.
My belly don't feel good. But me and her both belly don't feel good. I don't
My
know.
back doesn't, but I just took 3 ibuprofen.
Oh,
So
that'll
hopefully-
help. That'll help.
I've found there's not much that 4 ibuprofen can do.
Exactly. I have a GI doctor, and I was taking 8 a day. I had an access. He
Yeah.
said, girl, we gotta look at your stomach. But it was
Oh,
okay.
yeah.
Yeah, he
Yeah,
was
because
worried about
they'll
it.
give you ulcer and all kinds of stuff.
I do have a GI, I have gastritis, but that's just inflammation in the lining in your stomach. I'm good.
Learn something new every day.
I'm good.
All right, ladies and gentlemen, folks, we've talked caps, we've talked NOI. What are we talking about?
Me.
Oh,
Just checking.
she's fine. She's like 12. She can bounce back from anything.
That's true. Yeah, you got it. Quicker it is.
She's durable. All right, so
It's the older ones in here who hurt.
I know.
Like,
Like, I'm wearing now. Like,
never been so sick of
bend
my life.
over, I'm hurting. So, gross rent multipliers, gross income multipliers. Let's talk about it. So we talked about cap. Caps are a way of quantifying an investment if it's a good investment. So typically, gross rent multipliers and gross income multipliers are also used the same way as a cap rate would be to determine if you want to buy this property. Now again, it's meant to be a litmus test. It is not a, ooh, it's got a bad multiplier, we just don't love. This one is way more of a very loose litmus test. Cap rates, at least you had to do some math, right? Some pretty intensive math to get there. Gross rent and gross income, there's not. The biggest difference is the gross rent multiplier is a monthly basis. So you're going to take the sales price divided by your monthly rent. Gross income multiplier is the sales price divided by the yearly income. So think of your income being your annual income, right? And your monthly being your monthly rent. Make sense? Mm-hmm. Otherwise, it's sales price divided by either monthly rent for gross rent or yearly for your income. Okay, that's your formula. It's not too tough. Not too tough. Ooh, that is not formatted right. Well, the first one sort of is. So this is real quick. I want you to take the sales price here. Remember, here's your key, and your gross annual rents to help me come up with some gross income multipliers. Remember, we're doing income multiplier, so it is on an annual basis. So this is how much they make on an annual basis. And I want you to give me the gross income multiplier. Sorry, the lines are a little off. You figure it out, I'll fix the lines.
I thought the gross annual rent was the GMI.
Nope.
Annual.
Nope. We're trying to, so follow your formula. Sales price divided by gross annual rent. Oopsie.
Oh, that is the gross.
Yep.
GIM?
Yep. So you're actually trying to calculate the multiplier. That's what there we go. That's what you're trying to figure out right now. Play from current slide. There we go. How's that? That looks better. Yeah, it looks better. So with all your multipliers, it's your sales price divided by, right? So in this case, sales price divided by your GMI, or GAR, sorry.
So is this how much you'd be grossing a month? Is that what you're figuring out?
Not at all. So you remember the cap rate is just a percentage, right? 10%. These multipliers are very much that. It's like a scale. We're trying to figure out if this
That's
one.
what they said. They wouldn't buy it if it was under 8%.
Right.
Okay.
Yeah. So they have a scale. So what the income and the rent multipliers are trying to do is you're trying to figure out a way to quantify how do I compare apples to apples. How do I take this apartment complex over here and compare it to this apartment complex over here? And compare it to this complex over here. Now, if you're doing your math, you would just be doing 80,000 divided by your gross annual rents, right? And what do you get for your GIM on this one? 9.5. 77.
Wait, do you
I thought
leave it
you
at
were
9.5? I put 9.5.
Those are the
Do you
cents,
add the
right?
two?
These are not percents. These are just a number. That's what I'm getting at. And so it should be, you could actually round it, but 9.5238 is the.
By yearly income, you mean by the rent yearly income or the person's yearly income?
The rent on the property. So this is
Okay.
a tool for analyzing a property. I'm looking to purchase a rental property, a property that makes money. I need to figure out this property versus this property or this property, which one do I want to buy, okay? So by taking sales price, how much I'm going to pay for it, divided by how much money it makes, I'm going to get a number. And this number is going to help me decide which one is the better investment. And I'm going to compare those numbers like I would a cap rate and choose from the number the best property. Yes, ma'am.
So in the formula it says monthly rent, so do you, for the gross annual rent, do you have to divide that by 12?
So great question. This one, gross income multiplier is the annual.
Oh, the yearly, okay.
If it was a gross rent multiplier, it would be on a per month. So we could actually divide these by 12 and maybe figure out what that is. Yeah. Follow so far?
Okay.
I feel like maybe I lost you a little bit.
But the 9.52, what he said was correct, right?
Yes,
So
yeah, it should
it's
be-
simply just the 80,000 divided by the 84.
Yeah, we're not doing rocket math here. This is-
Maybe that's the problem, everybody. Maybe we're
Maybe
just
I was
trying to
thinking
complicate
it. I
it.
think
Yeah.
we're just trying to figure out though why we're doing it. I mean, we know
It
how
should
to
be
multiply,
9.52,
but why are we doing it?
9.87, 9.86, right?
Comparing how much you're gonna make to
9.69.
how much you're buying it for.
So, and here's what you're trying to do. You're trying to analyze the market to figure out where should I be. So what was the number? 9.52.
Yeah.
What was the next?
9.7, 9.69.
All right, now here's where I want, this is what, so as an investor, I'm looking at 3 different properties, right? So these are rent properties in the area. And they all have this kind of gross income multiplier that looks about like this. So as an investor, I'm analyzing the area. So why don't I just take these 3 and add them together? And what is that? And then divide by 3, average them is what I'm saying. So if you add these up, what is that? 9 times 9, whatever these are, times 3, or add these up. Sorry, not multiply. Trying to multiply in my head and talk out loud. What is it, 29?
0.07.
07, now divide by 3. That's how you average. 9.69. So what that tells me as an investor is that the average rental in this area should have a gross rent income multiplier of around 9.69. So if I'm looking at a property and it's below 96.9, it's probably not performing very well. If it's above 96.9, it might be doing very well. This is very much a,
Wouldn't below be better?
would it be
So
better?
you're comparing your income to what you spend, so the lower the number, the more income you're getting to what you spend.
The sales price divided by, yes, I said it backwards. Did I say backwards?
Yes.
What did I say?
You said the lower the worse.
Yes, so the lower the number in this is better, correct. So the lower the number, and ultimately that's what you're trying to do is to figure out what's the average. What are things running?
But the cap
So-
rate should be high, the higher the better.
Yeah, cap rate is higher the better, multiplier the lower the better. Yeah. And again, this is a litmus test. This is not like, oh, that's a 5.0. That's a slam dunk. Maybe. Let me look at it. That's one I want to investigate. Okay, that's all this is meant to do. Is basically for an investor who may be looking at hundreds of properties, a quick way to determine, is it in line with the market and is it worth me investigating? Is it performing better than the average or worse? And then I determine which ones I want to go look at or investigate the numbers on. Did I lose you? I feel like I lost you.
Why do you want it to be lower? Because it's the expense?
Yeah.
Expense?
It's the
Making more
income
per-
it's the income to expense ratio essentially. Yeah, you're making more but spending less. The biggest difference here is annual versus monthly. If it's a gross income, it's an annual basis. If it's a gross monthly income, it's a monthly rent, right? Everybody see that? Same process. So how much is the subject property worth if the gross annual rent is $8,100? So in this case, I give you a gross annual rent here of $8,100. How can I figure out what I would pay for the property?
About 9.69.
Yeah, so now I can figure out based on about what I would expect from the market, what would I expect to pay for it? Alright? Same way as cap rates. So if it's, and again, normally we do sales price divided by gross annual rents. So if we have, what's our gross annual rent here, right, 8,100? Then what divided by 8,100 gives you 9.69. 78,489.
Is that right?
Is that right?
5, yeah.
Yeah, so
said 78,500.
Yeah, 78.5, yeah, because I'm probably not gonna give you $89. So 78.5, rounded to the nearest hundred. So this is what I would be willing to pay for a property that's performing this way in the marketplace. Does that make sense?
Yeah.
Some of you are like, next question, please. All right. So now I'm looking at the gross rent multiplier. What am I looking at on a gross rent multiplier?
Sales price
Monthly?
divided by
Monthly.
rent.
The gross is the monthly. So we went from income to rent multiplier. That's going to go monthly. So we got a property that's sold for $800 and has annual rent of $120. What is the gross rent multiplier? Now remember, I'm looking at a monthly, right? So the formula says what? Sales price divided by equals, right? In this case, we need to figure out what's the monthly rent. So 10.
Divided by 10.
Yeah. So in this case, we're going to pay $800,000. Oopsie. 800,000 divided by 10,000. 80. And that's our gross monthly. I'm sorry, not gross monthly. Monthly
Gross rent multiplier.
gross rent multiplier. Gross rent multiplier. Okay.
Oh,
Gross rent multiplier. Gross rent multiplier.
Where did we get 10,000 from?
We took the annual rent
Oh, divided
and
by
divided by
months.
12. Sorry, I skipped that step because I could do it in my head. Sorry about that. So the annual rent divided into monthly. So just remember, if it's income, it's annual. If it's monthly rent, it's monthly rent, right? And then this is done the same way. I could do the same thing, 80, get that same number, take the average, and use it as a comparison to see how it would perform with other rental properties in the area. Everybody okay? Okay. All right, let's try again. Appraisal principle that determines a value most likely to produce highest and best, or I'm sorry, the highest price in the sale of a property is known as a principle of what? This is just review. The appraisal principle that determines a value most likely to produce the highest price in the sale of a property is known as what? I kind of gave it away when I said it. Highest and best use. We're looking for highest and best use to make sure that we're getting the highest amount of money. Okay? For appraising a 20-year-old single-family residence, the best data is what? What's my best data for determining that? Nailed it. Recent sales. This is the sales comparison approach.
Is that gonna be the best way in every like commercial, residential?
No, not always. In this case, and that's what they're testing you on here. I'm telling you it's a type of property. It's asking you to tell me what's the best way to evaluate it. And in a residential perspective, sales comparison approach is going to be your best way to go. All right. Assuming the net operating income remains constant, if the cap rate increases, the present value of the property will do what? If cap rate goes up, increases. So the only way I know to do this
If it stays the same.
is to fill it out. Like I just play with the numbers. So if the capitalization rate increases, is that what it says? Capitalization. Yeah. Assuming that net operating income remains the same. So if we have $100,000 NOI, right? And the capitalization rate increases. Now this is going to seem counterintuitive, so hang tight, okay? NOI stays the same. Let's say it's a 10% cap. It's a capital rate increase. So what's 100,000 divided by 10? 10,000, no. $100,000 divided by 10%, sorry. That would be helpful. Should be $1 million. If I'm correct, right?
Yes.
So this means if I have a property, it makes $100,000 NOI, and I expect a 10% cap rate, I would pay $1 million for it. Everybody follow me? This is why the T-bar works here. It works so good on cap rates. Just remember the formula. NOI goes on top, rate and value, times, divide. Are y'all with me on this?
So as it goes up, it decreases.
So
Yes, and that does not seem, this is going to trick you up. This is why I'm telling you, just make numbers up and write this. So now the question says, if NOI stays the same, and the cap rate increases, actually let's be ridiculous, let's go with 15%, okay? 15%.
it's gonna decrease.
Gonna decrease. What is 100,000 divided by 15%?
666.
I just took this right.
Ooh, let's
Oh,
go with,
Jesus.
let's go with 16%. Let's do that again. Let's try 16%.
So
Yeah, that's-
it's gonna be more than a bit, but let's,
625.
625. Okay. So if NOI remains the same and the cap rate went up, the amount I'm gonna pay for it did what?
Down.
That seems counterintuitive. That's why I'm telling you, just do the numbers. Because if I try to tell you that, you'd be like, you're wrong. If-
Make some numbers up.
Yeah, exactly.
Percentage.
Yeah, exactly what I did. Just pick some random numbers. It's always gonna work. NOI, rate, and value. If I'm comparing apples to apples, how does that work? What happened? Went down. There's your answer.
Just so I understand like how this works, how does the net income remain the same and the capitalization rate goes up?
your cap is a percentage on the value.
Yeah. And so ultimately it has to do with NOI is how much it's making. A lot of times NOI is a percentage of, it accounts for expending a percentage of your expenses.
Mm-hmm.
So because essentially that is a representative of your expenses, your profit margin is more, or
Your profit margin
it
goes up.
changes, right?
Yeah, it changes.
Yeah.
Just
So-
it's interesting that, I mean, I know
I
this
know,
is
right?
very theoretical, but,
It does not make sense.
right.
Well, that's why I say to write it out. But it does have to do, it has to do with NOI. It's how we figured NOI, right? Remember, with NOI, we talked about how much it does make, vacancy and collections, operating
It
expenses.
just seems like if your capitalization rate was going up, your income rate or your operating expenses and stuff like that would go up too. Or your NOI would go up.
It could, but if NOI changes or doesn't change, the
Then
cap
yes.
rate does change. Anytime you change two, or anytime you change one, you're gonna change two. Questions on that one? I know it doesn't make a lot of sense. The only way I can tell you to make, I can't really rationalize this one very well. This is just, I have to play with it. But it does essentially have to do with the percentage of the investment. Alright, so an investor requires 12.5% cap. An apartment complex has an effective gross income of $75,500. With the 5% vacancy and collection losses and annual operating expenses of $318, what's the value of this property to the investor rounded to the nearest 100? I'm sorry, nearest 1,000, sorry. So I'll give you a second to work on it. This is your formula, right? This is your cap rate. Now you also need to know what else.
The first formula.
Yeah, how do I get NOI? It's not as many steps as you think. Well, you gotta check like a little one shot.
I know the first class I came in and saw everyone eating and I was so hungry. I was like, okay, it's cool, like bring dinner here, yeah.
Gotta keep the brain fed. mostly because, depending on how you read the question, it's not really worded that great. The question reads 755 with the 5% vacancy in collection. So some people would interpret that as saying that includes the 5% vacancy in collection.
Oh, I didn't do
So
that.
I'm not gonna,
It
I'm not gonna ding you either way. If you wanted to say that that was inclusive and do it that way, that's fine. If you wanted to minus the 5% out of that, I'm kinda fine with that too.
Okay.
I'm more concerned that you know the process. Your questions on your exam are gonna be much more specific.
Okay.
Because the good news is, if you worked it without it, it's just the 755 minus your vacancy and collections, or your operating expenses. Because they've already incorporated your vacancy and collections, so then this would be your NOI. If you assume the 755 is your effective, it's a little easy.
My answer's not on there.
You don't have to do it that way. We'll do it both ways so you can see it.
But it's close.
The reason your answer may not be on there is because to get one of these, this is the way you would have done it.
It's 755 500, by the way.
Oh, there's a 500 in there, yeah. Thank you.
So did these answers include the 5%?
So the multiple choice answers figured it this way. If you did it another way, we'll work it that way too, so you can see what that looks
I
like.
didn't figure it with that, I got one of those.
I subtracted 5% to that.
Either way you do it, you get an answer up there.
Oh, really? Well, that's probably the purpose of the question. I don't love this question because of the way it's worded. That
I got C.
they used to write them much more tricky than this would be a much more representative example of a historic test question. They have rewritten the exam, most of it for these type of questions to help eliminate some of the confusion. But we'll do it either way, because as long as you're good at the math, that's all that matters. So if we did it this way, what is my NOI? What's 755 minus 318?
437,500.
4375. Okay, so that's my NOI, right?
Yeah.
And if I know my NOI, I can figure out rate and value, divide, multiply, what's my rate?
437.
12 and a half.
I want a 12.5% rate. So if I'm dividing my NOI, divide my rate, what do I get?
3.5.
So the 5% had nothing to do with it?
So the assumption in the question is that it's written in such a way that you would read it, hopefully, and realize that 755.5 was inclusive of the 5%. It's not worded very well. If you should see it written this way, that's what you should assume, but those questions have been eliminated. They're not written this way anymore for this reason. So this should be the answer you got, which would be 35D, right?
I
But
subtracted out 5.
let's try it the other way. So 755, 5, what do I need to do to get your way?
Times
Times
0.95.
5%.
Take off 5%.
You can times it 95%, because now I'm skipping a step because we're short on time. What is that?
37,775.
37 what?
775.
So you get the NOI.
775. Am I missing one?
No,
What's left?
37,000.
Oh, wait, that's 5%.
This number needs to
Oh,
be
that's
95%.
That's 5%.
That's 5%.
That's 5%.
Oh, that's
I'm sorry.
5%.
I-
Yeah.
Okay, so
I
this-
did have
this
to
is-
try.
I was like, I know I saw that
I
number.
thought 5%, and I
Yeah.
subtracted.
I got the
So that's the
same-
5%.
That's what I did.
If I done it by 95, what would I get? Or subtract it either way. 751, 225.
Yeah.
So now what number is that?
That's
That's
your,
So this is how much, assuming this would be, if this was considered to be the potential gross income, and I take out what would have been the vacancy and collections, I would be left with my effective gross income,
yeah.
right? And if you take the effective gross income minus our operating expenses of 318, 318 even, yeah. Then what number are you left with?
399,725.
Which is,
C. If you divide it by the
Divided
rate.
by 0.125.
That's not right.
Divide
Divide by the 12.5%.
Yeah, divide by the
Hold on.
12.5%.
this is
Yeah,
my
and
operating
divide by the
expenses.
Yeah.
Oh,
yeah.
right, duh. So then what number was this? I'll re-erase it.
399, 725.
399, 725. There we go, that's my NOI.
Yeah.
Now we can do this. There
12.
we go. The rate of 12.5%.
So that's the right way.
Neither of these would be, the problem is on the board, this is the right way. The fact that you know how to do it both ways is fine by me because the question is not gonna be this tricky. It's not going to word it in such a way that
You
it
don't
would
know
be
really.
ambiguous as to whether it was included.
And
So
to
that
include both
question with those
answers, that's
answers
messed up.
wasn't testing if you knew how to do it or not, it was testing if you knew how to read.
More so, yeah, because
That's
the
very
questions used to be written this way.
written.
We had a very C2J with the real
Well, then
estate
how could
commission
you
on
not
Sunday.
assume that the 318 was already in there too? With
Because they tell you
I mean,
operating.
Gross
It says
income.
with
It's so
and.
vague. It's
What was our answer here, by the way?
I'm having
Was it
trouble.
C or D?
3,198,000.
Oh.
And then I rounded up to.
Y'all ain't gonna mail, how are y'all getting at 399? Cause in my calculator, I'm getting 433,225.
Oh, you add.
He said there's two ways to
Take
do
out
it,
the
either
5%
3.5.
and
You
the
take out this
suspension.
5% from your 755.
No, I'm going from
Either
the
C or D
EGI
is the
of
right answer.
751,225 and you minus 318, I'm coming up with 433,
Depending on how you
225.
I got
I don't know why it's doing that, it's maybe something funny with my
It might be on the, it might be a decimal.
Oh
If
wait,
you read
Hold
that
on.
as, you still gotta take the 5% out, then you get that.
I hate that.
It is for.
It's not a great
that
question.
See, we
Yeah, I
also
love
took
that
out-
question
we also
because,
took out the 37,775, which is the 5%.
it really is. Honestly, I should probably delete this question out, but we did used to have to teach this question because when you saw it written that way, income with, the with means it's already included.
yeah, because effective gross income is already the step after minusing the vacancy and collections.
Right. Which effectively they would have given you.
So you get 395.
But you can do it.
I quit.
No. Don't quit. Cap rate, what is the cap rate or rate of return
Too much invested.
on a property valued at 6.79 million to the, if the net operating income is 787,
Oh, that's.
right? This is just that same formula right there. So they give you NOI, which is beautiful.
Give you and the value.
787, 640, and they gave you the value? Yeah, how cool is that? 6790. And this way I divide, and this way I multiply. See why this is beautiful? This is the best place for the
Yes.
T-bar in the whole class.
So, I like that.
Okay, so.
Yeah. Cap rates, I love it. And so this, you could divide 787 divided by this and get what? 11.6%, which would be.
640 divided by.
They will teach you that T-bar, and they'll teach you in your math book on just about every problem that we do in here. They like to try to apply it. What they've tried to do is come up with a universal way to attack every math problem, and I just don't believe there is one. This is the best place in the whole class for the T-bar. And you need to know it. Just remember, NOI goes on top, rate and value on either side. You'll be fine. What's a good thing to do with that information when you walk in here?
Write it down first thing.
Yeah, we call it a brain dump. You're gonna come in, you're gonna have scratch paper, anything that you're having trouble remembering, or if you're just worried about forgetting it, come in, write it on your scratch paper, dump it there, and forget it. And then you can just put your mind at ease. Like, am I gonna remember that when I get there? You don't have to. You've got it right there. So when you get to that problem, you can reference your notes. So that way you're not stressing about remembering everything. Just get your paper out, dump as much as you can on that paper, and then start your test. Test taking technique. Y'all ready to talk taxes? Y'all ready to move on from NOI? Don't get too comfortable, we gotta come back to it. We gotta do before tax cash flow, which you'll love. You'll love it. No, you won't, but we'll come back to it. Alright, let's talk some taxes, shall we? We're gonna talk about which items are tax deductible, how to calculate gain or loss on a property, and understand cash flow and return on investment. That's that before tax cash flow we're gonna talk about. So are you a CPA? The answer is?
No.
I don't know, are you? Is anybody here CPA? I don't know, sometimes there is. I had an attorney once. This lesson is for informational purposes only. You're never going to be giving tax advice. This is not what we do. We're not a lender, we're not an attorney, we're not a CPA. We are always going to defer to the appropriate professional. However, it's great to have an idea to tell them, hey, you may want to ask your CPA about whether this is a tax deduction. Rather than paying cash for your whole property, you may want to ask, is it better for your financial picture to have a small mortgage so that you can deduct some of that interest from your income? Because mortgage interest is deductible in some cases. What can I deduct on my current year tax returns? So interest on your real and real property taxes are currently a tax deduction. So this is, again, they want people to own homes. It stimulates the economy, it makes everything move. So they give you some incentives to own homes, which again, interest and real property taxes become a tax deduction. If you paid any points, you could possibly deduct them unless you're on a refi. It doesn't count on refis. Loan origination fees, those are going to show up as a tax deduction. Again, you're only going to pay that one time, right, when you're buying the property. If certain income requirements are met, you may also be able to deduct that mortgage insurance premium. What is that? Mortgage insurance premium. Yeah, it's your PMI. It's actually MIP, you're right, but it's essentially the one-time payment at the closing. So you're going to pay this at the time you purchase it. Now it will obviously be a part of your payment going forward, but this is the one-time premium when you close. This is a one-time fee when you close. It's the loan officer's commission when they get you that loan. Probably just a one-time when you close, right? And then your interest in real property is an annual thing.
Would like a VA loan funding fee be considered a tax?
Possibly.
So you pay real property taxes just to deduct them.
Yeah, they can become a deduction from your actual income. Yeah, kind of cool. Unless you rent, and then it sucks because you don't get that. So mortgage interest, points, property tax, all right there. This is actually the mortgage interest statement that shows what can you deduct. So a screenshot of it. Is there a limit to the mortgage interest deduction? Well, yes, there is. The good news is it's only $1 million. So interest on acquisition debt up to the first $1 million. And interest generated on the first $100,000 of equity debt. Equity debt is your second mortgage. So rarely are we going to have $1 million worth of acquisition debt. You might. I mean, ultimately, if you're buying a $400,000 or $500,000 property and you're holding it for a long period of time, you could hit those numbers. We've done interest math, right? We know it doesn't take long to get up to $100,000. But it's on your acquisition debt. Again, you're purchasing it for your property, and then $100,000 on equity debt. By the way, there's a fair amount of law changes that have transpired with the last tax bill that came out with Trump's tax bill. Some things changed with this. You're not going to be tested on that. You're going to be tested on what I teach you. The test that you're taking was written prior to that coming out. Okay. Yeah. Now, if you were in this class in January, different story. All right. Will my gain be taxed? Now, first of all, let me ask you what your gain is. Let's run that back up.
Income you make off of it?
Yeah, it's your profit. Your gain is how much did you receive, your profit. So will you be taxed on your gain?
Yes.
It depends. Just like everything. So this is the most, to me, important part of the real estate investment or owning real estate. If you can tell me anywhere you can find tax-free money other than this, I would be super excited about it. Because to my knowledge, this is the only place you can truly have tax-free money. You can have tax deferred, you can pay it later, but this is truly tax-free money. So if I am single, up to $250,000 of my gain, of my primary residence that I have lived in, 2 out of the last 5 years. So I've lived in this house as my house 2 out of the last 5 years. I can receive $250,000 in profit tax-free. If I am married, it doubles to $500,000 tax-free. Now these sound like big numbers to us, right? If you are in New York or if you are in California or Chicago, these are easily obtainable numbers. When you're buying $1 million properties and making $250,000, that's not uncommon, right? Especially if you've held it for a while.
You said 2 out of the 5. You've got to be there for 5.
2 out of the last 5 years. Yeah, and there's no order. It can be the first and the 5th year. It could be the 3rd and the 4th year.
But if it's just 2 straight years.
It doesn't even have to be straight. It just has to be 2. And could be 6 months in over a 4-year period.
Is
So,
this national or North Carolina?
this is a federal, yeah, federal. And it's the only place, and by the way, this has been on the chopping block dozens of times. The feds do not love this because they have realized this is the only place I can make $250,000 and they can't touch it. Now, this is not for investors. If I'm flipping houses, I gotta pay gains on my taxes. Doesn't matter how long I've had it. If I'm buying it to flip, if I'm buying a rental and I have it for 5 years, I'm going to pay long-term capital gains. If I sell it in less than a year, it's short-term capital gains.
I was just saying, even if you're gonna flip it, live in it for 2 years.
Absolutely.
Exactly.
I went on a listing appointment a couple of months ago, and these people had inherited a house and they wanted to sell it. And I said, well, where do you live? And they said, I rent a house right down there. I said, why don't you just move in this house for 2 years and call me back? Because it was paid for, it was an estate, it was paid for free and clear. I said, move in this house, make it your house, sell it to yourself, put it in your own stuff on the deed, and then live in it 2 years, then call me back. And then all the money you make on it, nobody can touch it.
If you inherit a house, then there's something. about
Inheritance tax, yeah.
Yeah,
That's
but
why I said sell it to yourself.
Yeah, but it doesn't start it starts way on up there though, right? If it's
It can,
over.
yeah, and I told them to check with their estate on how it was written. But that was a great tool for them, because again, if I buy a rental property, I can move into it, right? As long as I live there the last 5 years of my primary residence, I get gains.
What situation were you saying that it was worth paying the gain tax for a rental?
Well, ultimately, and this is a business model decision for investors. If I buy a house, so let's say I'm a flipper, right? I flip a house, I make $25,000. I'm going to pay tax. I'm going to pay a short-term tax. If it's a short-term, I think it's 30 up to about 30%. So short-term is much more tax than long-term, which I think is only 15%. Y'all don't have to know that, doesn't change. But flipping properties, you pay, and that's why people are like, oh, I made $30,000. Did you really make $30,000? Because after your expenses, holding cost, and gains tax, how much did you actually make? And that's why most of my investors, if they don't make 15 minimum, they won't touch it. Because by the time they pay their holding costs and expenses, or if they end up holding it for a little bit longer, it can easily chew up a gain. So it's a risk. Real estate investment is a risk. It's just like stock market or anything else, but it's more of a calculated risk. But this is where I get so excited, right? Because all of my clients are like, I don't have any money to invest. Yes, you have the best money to invest. Let me buy you a good deal on a house. You pay your mortgage down. You improve your property. You fix it while you live in it. You call me in 2 years, and you can make gains. This is how I got my investment career started. I bought it was a foreclosure, but it was in decent shape. Moved into it, lived in it in my primary residence for 2 years. Now I should have kept it and rented it, but I needed the gains because it was tax free. I sold it, I made $40,000. That $40,000 was in my pocket. The government could not touch it. I then put it into my Oak Island property that I ended up given to me basically.
But if you're just, say you just have the one house, and if you're going to another house, if you make $100,000 on this house and you put it into the next house you get, you're not paying gains on that too.
So what you're talking about is a 1031 exchange.
Yeah,
and
that's
that
what I'm talking
is the
about,
case.
yeah.
Now, if I'm an investor and I flip a house and I make $15,000 and I put it in my pocket and then I go buy another house, I'm still paying tax on it. What she's referencing is 1031 exchange, right? Which we alluded to a little bit. We'll talk a little bit more about that.
Alright.
Questions on this? Yeah.
Actually, I have a quick question. Where it says the interest on acquisition debt up to the first million, when it says debt, does that mean just
Loan.
what you pay or strictly loans?
The loan.
Just loan.
Yeah, the interest on the loan to buy it.
Okay.
Yeah, you have to kind of they use big words to make it sound more difficult than it is. Interest on a loan, acquisition debt, loan to buy it.
Okay.
Translated to simple. Other question? Cool, you're due for a break. Go get some air, come back.